Greetings, everyone. It is In the Know Day as well, Employment Friday. And we have a lot to discuss. As usual, we'll go through fiscal policy, monetary policy, economic indicators, market indicators, and we'll talk a little bit about some real breakthroughs in terms of the market recognizing how much innovation is taking place. So starting with fiscal policy, and I'll go through and just make a few observations before we flip to charts. So on fiscal policy, well, that big, beautiful bill is causing a bit of a ruckus out there, as I'm sure you all know, with President Trump and Elon Musk having different points of views. I think the way this is evolving is Elon, Tesla, and investors are beginning to understand more and more just how much the government has control here. SpaceX has $22 billion in contracts, government contracts. Regulation will impact the transportation sector. We are hoping that the regulation for autonomous taxi platforms turns into federal regulation as opposed to state by state, which would accelerate the rollout of autonomous. And of course, Neuralink is subject to FDA regulation as well. So there's Elon is involved in companies that are depending on the government. And I think his beginning to dial it back by first deciding to decommission the Dragon spacecraft, which brought the two astronauts back from the space station, and then basically saying, no, that's probably a bad idea. I think we're beginning to walk this back. Now, one of the hypotheses out there is that what has happened was partly, not entirely, orchestrated. Clearly, there has been some brand damage to Tesla, which he readily admits. And I think he's trying to disengage from the government and being associated with one party or the other. There could be another interesting I guess you'd put it in the 5D conspiracy theory, and that is that President Trump is negotiating in a very tough way with China, and of course China is a big part of Tesla's business, both production and consumption. And so he certainly doesn't want to be impaired there. And of course, the big negotiation is around rare earth materials. And so it is interesting that today that China, through Reuters, I believe, announced that it was going to release rare earth materials or open back up the trade with the big three Detroit automakers. Now, that doesn't include Tesla, but this is a beginning. So that's very interesting as well. So we think there's more that meets the eye here, but nonetheless, and it did get out of control, clearly, I think. And I have been asked during Brainstorm today, if I were on the board of Tesla, how would I respond to this? And one of the things I've observed is over the years since we've held Tesla is that Elon Musk works really well under pressure, and he creates a lot of that chaos and pressure himself. So I think part of what's going on right now as well is his confidence in the robotaxi rollout is increasing. And he does expect that it's going to be successful, dependent on regulation, of course, for how quickly this success will come. And I think I would be advising the chair of the board and others, just to encourage him to get back to the future, back to really changing the way the world's going to work. And he did say that that's what he believed his role is, to accelerate growth and help get us out of this deficit through growth, deficit as a percent of GDP coming down, as growth in the global economy, and especially in the U.S. economy, accelerates in response to these massive new technology opportunities. I also, as an investor, we have to evaluate this situation in the context of the 6 metrics around which we have centered our bottom-up analysis and evaluation. Of those 6 metrics, thesis risk probably increased, having to do with regulation, as I just mentioned. So we will see how much both President Trump and Elon Musk dial back what happened, the drama yesterday, and see how much thesis risk has gone up here. The one thing we do know is that both of these individuals want to change the course of history in many ways. President Trump wants to be the greatest president ever. Well, that's not going to happen if he's bogged down in one fight after another. He needs to get the tariff fight behind him, and he definitely does not need another fight on his hands. And of course, Elon Musk wants to get to Mars and transform the universe, shall I say. And he doesn't need to get bogged down either. So we do think they will, at the end of the day, listen to that kind of reason. And as you know, we're used to volatility in our portfolios. So after the election, or since the election, we did, all told, net, sell nearly $500 million of Tesla, expecting some other reason for volatility. So we try to use the volatility to our advantage. And of course, as Tesla was taking off after the election, there were other stocks that were not. And so we recycled and so forth. Just to finish off the scoring system, in terms of people, management, and culture, some might question, should our score there go down? Well, as I just mentioned, we've lived with Elon and through many cycles, and we are used to this. As you will remember, the SEC did come after him. That was the one time we dropped the score, because that was going to be a huge distraction for everyone. The board, employees, Elon Musk himself, the management team. And we pretty much have left the score there for this kind of reason. The second is execution. I think the robotaxi is our big focus here. June 12th is the day. So let's see how that goes and how we change that score over time. The other is product and service leadership. That one has come down as Tesla has lost some EV share because of all of the drama. And we are betting that the news cycle is going to change here and move towards robotaxis to change that score and move it back up. And moats and barriers to entry. This is where it's going to be very hard to beat Tesla at robotaxis and at humanoid robots. And that's becoming a bigger part of the story than even we had been modeling in. So stay tuned for that. And as I mentioned, dialing down exposure as the stock soared is part of active management in the ETF wrapper. which before we really happened upon the scene in 2014 wasn't even a thing. Most of the ETF world was passive, but now, as I'm sure you all know, a lot of other management teams are moving towards the ETF wrapper as well. So just felt we should explain a little bit, given all of the drama out there and how much Tesla's stock price did drop yesterday on Thursday, the day before Employment Friday. It's rebounding nicely now, and so let's see what happens here. As far as the rest of fiscal policy, all eyes on the bill and when it will or will not be passed. We do think it will be passed, and the question is, will it be by July 4th, as President Trump is hoping, or in August as we're hitting up against the debt ceiling? Well, the way Congress works is it responds to pressures much like the debt ceiling. So our bet is on August. And with that clarity, we will have a lot of uncertainty taken off the table. Most importantly, the tax hike that would otherwise occur automatically at the end of the year. And so businesses will probably make more decisions. And in fact, if there's immediate expensing of equipment and structures, then that alone could take the effective corporate tax rate down to 14 or 15%, which is one of the president's goals. Now let's go to monetary policy, and I'll show you some of these charts. But in terms of thinking about Chairman Jay Powell's testimonies recently, he's really focusing on core consumption and core investment, and not looking at trade, inventories, government spending, and some non-core consumption and investment. So, and in the first quarter, while real GDP was negative, 0.2%, this measure of core that Chairman Powell is focused on was up more than 3%. Now, if you take out everything that hit GDP, of course it's going up. Well, in the second quarter, according to GDP now, it's going to slow down. That metric is going to slow down to 2%. But core investment alone is dropping down 2.2%. Capital spending is getting hit. Again, companies are pulling back until there's more certainty. And so I think that measure will give Chairman Powell pause, especially if inflation remains well-behaved despite tariffs. And what we have seen recently is that companies have been taking the hit more to their margins than trying to get pricing through. And why would that be? Well, the consumer is fed up with high prices, and we're seeing a lot of companies report increased prices, but unit growth dropping. And that's in the necessities space as well as in the luxury space. So I think companies are changing their behavior a bit here. And you'll see when we go to the charts, it seems as though the high yield spread is saying the coast is clearing here for a nice recovery when we have more certainty from the tax policy and tariffs, of course. On to economic indicators. Well, Employment Friday, something for everyone, as has been the case in most employment reports over these last few years during what we've been calling this rolling recession. This one was no different. You had non-farm payroll employment up 139,000, which looked better than the 125,000 expected. But when taking into account the 95,000 in revisions, that was a disappointing report. And it's also important to remember that nearly 100,000 of those 139,000 were due to the so-called birth-death ratio of businesses, so new business openings, and those get revised. So I think the employment numbers are going to be revised fairly significantly when we look backwards in time. They revise those on that basis, I think, every 5 years. The other thing that we learned is that the diffusion index for employment is right at 50%. So half of the employment categories are increasing and half are decreasing. That's down from 80% increasing at the peak in 21-22. And I think 70% compared to the peak in 2017-18. So quite a bit below that. We also saw household employment, and I don't believe this number at all, but down almost 700,000, and the labor force down almost 700,000. That's flaky. I'm sure that's there's some mismeasurement there. And we had, besides the number of industries showing declines, we saw the participation rate dropping here. So that is also something the Fed pays a lot of attention to. When all is said and done, when you tally it all together, including the 0.4% average hourly earnings increase, income is fine, but it's just dispersed. It's been skewed, as we know, towards the higher income level, and that skewing probably is continuing as we move toward the end of what we're calling this rolling recession. I'm going to spend a lot of time in the charts, and I'm going to start with the charts now on housing, but let's review just a few of the things I've mentioned. So on this first chart, you can see the deficit as a share of GDP, not seeing any improvement yet. And Scott Bessent has committed to, where you see the X there, getting this to 3% as opposed to nearly 7% or 7.5% over this administration's tenure. And we think it's going to come about more through real growth accelerating, and we think that productivity-led growth will be very powerful in this regard. And of course, there are some efficiencies that are being built into this bill, however much Elon Musk does or does not like it. And the reason Elon does really focus on government spending is it is taxation, one way or the other. We're going to have to pay this through taxes now, taxes in the future, or the cruelest tax of all, inflation, inflating our way out of the debt. And if anything, we think deflation is where we're going here. And so this debt will be very difficult to service if we do go into a deflation unless unit growth really booms. And we actually think that's possible moving into 2026. So on the next chart, I mentioned corporate tax rates. You can see here, X marks the spot where the corporate tax rate would go if there was immediate expensing of equipment and structures. And you see, you have to go back really to the 40s, the late 30s and 40s, to see a lower effective tax rate. So that will be quite an accomplishment if and when it happens. Here you can see money supply. The growth rate has rebounded after nearly a year and a half of negative in terms of the level falling. And if you take a look at this chart, which goes back to 1960, you'll see that where we are with monetary policy now, or money growth, is at the low end of a range. The range was lower in the early 90s as Chairman Volcker and then Chairman Greenspan were trying to squeeze inflation out of the system. But other than that, it's rarely been lower than this. And if we're right that the velocity of money is slowing down based on all of the uncertainty out there, tariffs, tax bill, government spending, and so forth, then this I think the number is roughly 4.4% growth on a year-over-year basis, is lower than nominal GDP growth is right now. And if the velocity of money is slowing down, declining as well, that's going to be another pressure on GDP. So we do think we're entering the last leg of this rolling recession. I have no idea if we'll actually see another negative GDP quarter, but we do think the velocity of money is arguing against a very strong GDP growth. On this next chart, you can see the core PCE index. This is very important, a very important inflation metric to the Fed. And here you can see there was a little bit of stall in the 2.5% to 3% range, and it is starting to break down. You can see one of the reasons is here. Gasoline prices are moving down, certainly on a year-over-year basis. They're down quite a bit. And you can see trueflation. So this is the measure of inflation, real time, 10,000 items analyzed in real time or updated in real time. And a lot of people have been wondering if the tariffs would take this back into the 2 to 3% range. And it got us to 2, but the latest tick has been down to 1.8%. This metric tends to lead the CPI by, I think it's 60 days, if I'm not mistaken. So it would suggest there probably are some more inflation surprises. On this chart, real GDP versus productivity growth. So I mentioned nominal GDP is I think it's a little below 5%. This is real GDP in the purple. You can see it's a little below 2.5% as of the first quarter. We think it will continue to decelerate here. And typically, productivity accelerates as GDP growth accelerates, or as unemployment rate goes up and fewer people have to do more. So right now it's a bit sluggish, but if we're right as we get into a broader based or starting with a rolling recovery and maybe an economic boom in 26, we think this productivity measure in the green here will go to much higher levels than we've seen at the beginning of past cycles. You can see in 2020 we got to roughly 7%. We would not be surprised to see more of a burst given what's happening with AI and how many companies are beginning to flatten the hierarchy within companies, taking middle management out as more and more people can do much more with by harnessing these technology tools. Here are auto sales, just to update you on that. We had the burst ahead of tariffs, and you can see now where we are that I think it's 15.7 million units at an annual rate, so we're reversing already, and we would not be surprised to see this drop below the 15 level again before the recovery starts. Here's a gauge of capital spending. The last time we presented it on a year-over-year basis. Year-over-year, it is starting to fall. You'll see what the AI boom and the power generation boom is doing. It's helped it to level out. But if those two areas are booming, then other areas are falling. And again, that's because of the uncertainty, all of the uncertainty around tariffs and taxes and government spending and so forth. On the next page, you can see the most rapid bounce in the trade balance ever in 1 month, in a 1 month period of time. So imports collapsing, I think they were down 20% in 1 month, is the reason. There was huge imports to avoid tariffs. That was why we got to such a crazy deficit level. It's coming back. And let's see what happens here. But what's interesting about this, the imports falling, imports rising is a drag on GDP growth. Imports falling is a benefit to GDP growth. The question is, where do they land? Are they pulled through in consumption? Or do they land in inventories? If they land in inventories, and we think that's a more likely, more of them will land in inventories than will be consumed, then that's not a healthy source of growth. And here you can see, this was a very interesting report from this week. This is ISM of services. Now, services are a much bigger part of the economy than are goods. But here you can see price elasticity of demand really taking hold. Prices, they've tried to push those prices up. That's in the purple line. And look what's happening to units. And, services rarely fall unless we are in a recession. And you can see evidence of a kind of rolling recession, even in this metric, starting in 2022. So we think this response, units falling, is going to take away the incentive for companies to continue to push tariffs through in pricing. We'll spend a little bit more time on housing. I know that's of great interest to many people. It's their largest asset. So here you can see home sellers versus home buyers. Home sellers in green and home buyers in purple. And there's a big imbalance developing here, suggesting that the market is very weak and that the buyers are probably not going to move unless they have a good reason. Either interest rates come down or prices come down. And you can see here what's going on with volume, very low by historical standards. I can tell you in the late 70s, when I was in college and started in this business, this metric was at 5 million units. And to see it at 4 million now after years and years of population growth is really, really saying something. You can also see here pricing. So again, many people fear that inflation will go up for all kinds of reasons. One of them is the supply-demand imbalance in the new home sale space. And in the existing homes, what we're seeing is prices decelerating. The reason this is important is this gets into the CPI indirectly and into the PCE indirectly. PCE core, I think housing accounts for 15 to 17% of that index. PCE total, I think it is close to 25%. All in, shelter in the CPI is roughly 40% of that index. Here you can see new one-family homes sold. They have come back in tandem as interest rates went up. They stalled, and you can see new home sales are well below the peaks, certainly during the housing bubble, and they're kind of middling. If you go back to the 70s again, they're at that level, which is really quite astonishing. And here you can see what's happening with new home prices. They are falling. So this, again, is going to get into the price indicators. It gets in with a lag, but it's been going on for long enough now that we think we're going to see it soon. And you'll have more people talking about deflation then. Not for a great reason. This is, buyers just saying, no, we're not going to buy unless you give us a better price, sellers. So as the sellers pile up, probably having no choice, they'll probably cut their prices. Now into market indicators. So starting with the dollar, we hear so much talk about how horribly weak the dollar is. Well, if you look at this chart in the context of history, and I know we go through this every time, but we keep hearing that mantra, the narrative, is just not true. If you look over the last 15 years, we've gone from roughly 70 to 100, and taking out the bubble in the early 80s, we're closer to the top end of a very long-term range than we are to the bottom. And you can see this on the next page in Bloomberg Commodity Price Index. Is still going nowhere. It is where it was in the early 2000s, the early 90s, the early 80s. So this is not an inflationary period. The period from 2000 to 2010 was highly inflationary by this metric, and by the measure of gold. Well, gold certainly looks like it's playing its role as a hedge against inflation, but other prices are not following gold. And here, I've been presenting this for a while. It's, to us, an astonishing chart. The ratio of metals to gold prices, new low. Even though silver prices, which is in the metals, have really taken off. So this disconnect between the metals to gold price ratio in the purple and the long-term treasury yield is being exacerbated here. We thought it would close with both of them moving towards one another, but that's not true. So this correlation has broken down for right now, and it's a correlation that's been in place for many, many years, even pre 2008. The correlation wasn't as close, perhaps, but it was there, as you can see. And that suggests to us that there is more weakness in the global economy than many people appreciate. It's probably in China. We do see China exporting deflation in a major way. Just look at the prices of BYD vehicles. I think they've got some now in the $8,000 range, and they're exporting to Latin America, to the Middle East, to Europe. I was in Europe, saw BYD dealerships popping up all over the place. So I think there's more of an export of deflation taking place than many people understand. Here, market indicators. So again, there are bears out there who say we're set up for another period like the late 60s to the early 80s, where this metric, the S&P price to gold, collapsed. And that was in a major inflationary period. We do not believe that's what we're going through now. And you can see there's a tug of war if you look at the recent behavior of this metric. But it looks like the test has been successful, and it looks like the market, the equity market, has has weathered so much controversy this year, the tariffs, the drama around the big beautiful bill and the Trump-Musk battle over it. So we think it will resolve on the upside here, not on the downside, and that again, I think goes against the grain. A lot of people are out there very negative about our deficit, our government spending, and we're not happy about it either. But we can also see a lot of reasons that growth is going to accelerate thanks to the massive amount of innovation taking place out there. Another metric that is pointing in a positive direction, unlike the late 60s to early 80s, is the S&P price to the oil price, and that's reaching for new highs, which is very positive. Crude oil going down is a major tax cut for most every part of the globe except for the Middle East, and so this is a very good thing to see. And of course, this week Saudi Arabia basically said, we want to keep our fair share. We're going to increase supply more. And I remember in the 86 period, this happened, and the oil price collapsed, and that was finally when people began to believe back then that inflation was not going to come roaring back. So let's see what happens here. Last few charts here, this is just a reminder of how much hard work the 10-year Treasury yield did over 40 years. And now we're getting back to what I would consider more normal. The 10-year Treasury yield tends to mimic the nominal GDP, and that's kind of where we are right now. If nominal GDP growth comes down, as we expect it will, we think interest rates will come down before all is said and done. But in terms of the range we would expect, we hope not to get into the 0 to 2.5% range again. That was almost heralding a very bad deflationary environment. And market signals, we lost all market signals. We want market signals, and the long-term bond yield is a very important signal. Here's the spread, the high-yield bond versus the 10-year Treasury yield. Again, closer to the low end of where it has been in the last 30 or so years. So the bond market doesn't see much risk out there. I will say I do subscribe to the risk that many people think is happening because too much money is pushing into the private credit world. And so this could be distorted, just too much demand for yield relative to supply. This could be where the bubble is. And so we'll see what happens there. And then I'll end on the Bitcoin to gold. This uptrend has not been broken. Again, this aligns with the net bullish risk-on kind of market that we think we're in, and I guess you can call the markets anti-fragile, which is a description used in Bitcoin. It's been able to withstand all kinds of turmoil, and we think the markets, the equity markets, are following Bitcoin in this regard. And I think there are two events that have happened in really the last week or so that suggest that risk on is where we are moving, and a market rewarding innovation. One is the Neuralink deal, and that was so oversubscribed. And you know, the animal spirits are alive and well, certainly in the private markets, but also in the public markets. The Circle deal which we had been monitoring Circle for a very long time, and I do have a little story there. Jeremy Allaire, who's the CEO of Circle, he was at the World Economic Forum technology conference in 2016, as was I. We were both asked to do different panels, and we sat in on each other's panels. My panel in 2016 was about Bitcoin. And a company named TransferWise was there. I think it's since gone public, a fintech of the day. And more traditional financial institutions were weighing in on this topic. And there was one Chinese Bitcoin miner there at the time. Little did he know he'd be shut down early in the next year. But I'll never forget, we were the two Bitcoin advocates on the panel, and at the end of that session, the broadcast journalist who was moderating our panel turned to the audience, and we were in a round circle. It was definitely a round table, and there might have been 500 people there, and said, "Who thinks that Bitcoin is going to be around in the next 10 years?" And only one hand in the audience went up, and that was Jeremy Allaire's. So we definitely bonded over that event, so we are delighted and congratulate them for their amazing debut in the public markets this week. I think in the first few days, the Circle is up 3- to 4-fold. And this gives us confirmation that animal spirits are back. And the fact that an apple could be down 18%, I think it is, this year, having really been the leader of the mega tech group, is forcing investors to take a look at other exposures to innovation that are maybe not in the Mag 6. And we think that is accruing to the benefit of, the next generation of innovators. So we're, of course, very excited because that's what ARK is all about, researching and investing the disruptive innovation today. So with that, I'll say, in a very timely way, I can't tell you we did this on purpose, but we published our stablecoin white paper, Lorenzo Valenti's work, yesterday on Circle's debut day. So take a look at that. We think this is a very powerful movement. We think the financial services sector is going to reconfigure completely in the next 5 to 10 years. And that, of course, Bitcoin and now Circle, and of course, Coinbase as well, Robinhood, others are, SoFi, I know, is now moving back into crypto in a big way now that regulatory clarity is here. So thank goodness for that. And I'll look forward to doing this again next Employment Friday.